Good morning, fellow investors. There's been a lot of inquiries out there on the web about ZIM integrated shipping services, ticker symbol ZIM. This company is getting all kinds of attention regarding its substantial, astronomical, bananas crazy 141% dividend yield when you look it up on Google. Now, that is not indicative of what you could probably expect in the long run for really any company, but this kind of company in particular, things are going to be, well, we'll just say cyclical. Now, what are they? Well, they're a shipping container move-in machine. Okay, they basically send containers all over the world filled with different products on these giant steamships. All right. Now, in case you haven't heard in the news at all over the last couple years, there has been a little something called supply chain issues. Now, what does that really mean? In the most basic sense, it just means more demand than shipping capacity, okay? And this was seen in a lot of different parts of the supply chain over the last couple years. Basically, any time from the end of the initial set of lockdowns in 2020 up through maybe the end of last year, it was pretty much all you heard: supply chain, supply chain. Okay, it just means more demand, more shipping demand than shipping capacity. Okay, simple. So, and what does more demand than capacity or more demand than supply mean? Price goes up. They could basically, in a lot of parts of the different businesses that shipped things, they could basically name their own price. Okay, and then that increase in price to move goods gets passed on to the end user in the form of, you guessed it, inflation. So enough of the supply chain lesson for you. The basic thing here is that that isn't going to last forever, okay? You know, in fact, their own forward guidance says that their forward adjusted EBITDA in 2023 is going to be 1.8 to 2.2 billion dollars, okay? Compared to 7.4 billion from fiscal year 2022. That is a very substantial drop. It's dropping well over half, all right? So basically, with that amount of drop, you can expect that they're not going to be paying any kind of, triple digit dividend, okay? Now, the fact of the matter is their dividend has been all over the map. They've just been kind of, anytime they've got a huge, windfall of cash, pretty much they've just been issuing a big fat dividend, all right? So I wouldn't necessarily try to predict what their dividends are going to be over the next few years. But while we're here, I figure we might want to look into, do they have potential maybe as, a good value today based on what we can see in the company. Now, as you can see, they don't really have a lot of track record. They haven't been publicly listed for all that long. So we've only really seen how they perform during these unprecedented boom times. That's part of the risk with this company, okay? So I can show you now. This looks like massive dilution, but it's really just a very small change in share count since inception, and it's been mostly stable, okay? So they're not actually, doing any kind of massive dilution, nor really would they have a reason to with how much money they brought in over the last couple years here. Now, on the financials, I love looking at the balance sheet for the shareholders' equity, okay? On a company like this, they they do make money based on what they do, right? Which is moving things from point A to point B. However, they have a pretty capital intensive type business. So what you want to see is that they've got more assets on the books than what they have liabilities outstanding. Because if they're in the hole on this, it means that basically they're probably in trouble. Okay. Now I'm seeing they've got a lot of vessels, because that's kind of how they move the goods is on those big steamships. Now under their liabilities, they've got a lot of lease liabilities. That's because part of their strategy to move the dial up and down with the demand in the market is basically leasing ships, to basically work for them, rather than trying to acquire or build new ones on the drop of a hat. That would be very difficult to do. So their solution is basically these lease agreements that they have. Now, obviously, that's a pretty big expense. Hopefully, if demand goes down, they, and I don't know, how these contracts are structured and whatnot. That would be a thing to dive into. Are they on the hook for a minimum, payment for a long period of time, like in the case of like a capital lease on a building, or is there like a buyout if they want to end the lease or suspend it or whatever? I don't know any of those details. That would be something to look into, because if they've got these 10-year agreements to lease all these ships, and there's not enough demand for them for a year or two, that could really turn back the clock on a lot of the progress they made financially during this unprecedented boom time. However, I do, on the surface, like how much equity they've got on the balance sheet. Okay, it's obviously it's not necessarily all that hard to achieve when you've got unprecedented amounts of money coming in. But I'm glad that they kept something back to make the company better, instead of just paying all of it out in dividends. Although they did pay a lot of it out in dividends, let's be honest. Now, when it comes to pricing them based on how much money they're going to be bringing in, I mean, the price compared with their projections on EBITDA, they'd be trading for about 1.5 times the earnings before interest, taxes, depreciation, and amortization, which is probably a pretty low multiple, to be perfectly honest. And their current market cap is around half of what the current shareholders' equity is showing, at least as of December 2022. Now, one thing to keep in mind is that they are paying a big chunk of cash out in a dividend coming up in, I think it's April. It's going to be what did it say? 750 or $769 million. Okay. So keep that in mind. They are sending out a big chunk of cash here soon. So I expect maybe some people will try to get in just for that payout. But overall, this is definitely one I want to look into a little bit more. There is potentially some some value to be had even at more normalized numbers going forward. It's just the big risk is that we haven't really seen the track record of what they do. They have, however, been around since 1945, so certainly this company has seen a lot of different, boom and bust cycles. So, time will show what they can do for shareholders during a more typical year. All right. So give me a like, give me a comment, let me know what you think of ZIM. Subscribe to the channel if you like looking at companies like this. Take it easy. Have a wonderful and safe weekend. Peace.